Hello, everybody. Welcome to Property, Plant, and Equipment. This is part 4 covering double declining balance depreciation. I'm the accounting professor. This is Bennett Tchaikovsky. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without the prior written permission from myself, the author. The opinions expressed herein are those of the author only and not the author's employers and or other affiliated organizations. So we're now going to be talking about double declining balance depreciation. We've already gone through straight line. We've gone through units production, and this is the third method we're going to talk about. I do not cover some of the year's digits intentionally. My discussions with different exams or different SEC examiners has indicated that no one really uses it. If you have to learn it for the CPA exam, that's when you'll take it. I also do not cover the tax depreciation methodologies. So this is financial accounting. So generally, remember, the big thing with double declining balance is we can only record up to the salvage value. Once our net book value, which is the equipment minus the accumulated depreciation or the depreciation taken to date, is equal to the salvage value, we have to stop. Okay, even if we're continuing to use that equipment. For double declining balance, there's 3 different things we need to know. The acquisition cost is in all the methods. Estimated useful life in years. This is for straight line and double declining balance. And then the amount of the accumulated depreciation or how much we've taken to date. Salvage value is not included in the double declining balance equation. Therefore, what we're going to need to go through and do is we're going to need to go through and make sure that the net book value never falls below the salvage value. What is the salvage value? It's the best guess estimate we have of how much the asset will be worth once it's at the end of its useful life. Why do we use double declining balance depreciation, right? So unlike straight line, which basically is taking the same amount of cost every single year, right? If we go through this over here, let me just go back and find it. So if I come over here and I'm looking at straight line, essentially the theory behind straight line is coming right over here, is that our maintenance costs are relatively going to be the same every year. Therefore, if we take the same amount of depreciation expense, our total asset cost is somewhat smoothed over time. When we're dealing with double declining balance, we're kind of assuming that the maintenance costs are going to be higher in the later periods, right? Just think about any type of fancy car. It's great for the first 10,000 miles. After that, it just goes up from there, right? So what the theory behind it is, well, because our maintenance costs are going to be going up for the asset later on in life, we want to be taking more depreciation now, earlier on, so that our total asset cost is smoothed out, meaning that the depreciation plus the maintenance. Now, this is really showing the use of the asset, but it's going to be relatively essentially smoothed. Okay, how do we compute it? We're going to take the acquisition cost, right? We're not going to subtract salvage value, right? That is really much more common to something along the lines of units of production or straight line, right? Rather, what we're going to be doing over here is we're going to be having over here accumulated depreciation, and then we're going to be subtracting accumulated depreciation, then we're going to be dividing that by the estimated useful life. We're going to multiply that result by 2, and that's going to give us annual depreciation expense under double declining balance. And I may be getting Zoom bombed by a kitten. We'll see what happens, right? So over here, so I'm not going to deal with salvage value, but I'm going to have to go through and consider it. And oh boy, this is exciting. We have a Zoom bombing. We have a kitten Zoom bombing. Let me see if Gray will make an appearance. There we go. Hello, Gray. This is one of my 2 kittens, right? They're actually real cats. We've had them for several years. But this is one of my 2 cats. This is Gray. Gray, you want to say hello, everybody? Got to give you props for doing the Zoom bombing. Yes. Okay. We'll see how long I can do this for with you like this. Okay. So right over here, Yeah. So we have over here, we've got our journal entry to go through and to record depreciation expense. This is always going to be going through and being the same. So let's go ahead and take a look at our example, right? So on September 1st, 2028, we purchased equipment for $300,000. Installation was 20. Shipping expenses were 40. Salvage value of the equipment is 100,000. Estimated useful life of the equipment is 4 years. So we have to go through and prepare these different items, and let's get to it. So right over here, right? So how am I going to go through and deal with this, right? So remember, for our equation, we're going to have our acquisition cost minus the accumulated depreciation divided by the estimated useful life, and we're going to multiply that result by 2. Our acquisition cost is going to be $300,000 for basically the purchase of the equipment. And then we're going to also have over here installation of $20,000. Then we're going to also have over here, we're going to have $40,000 of shipping, right? Remember, it's the cost to get that asset over here to us. So our total costs are going to be $360,000. For the first year, we have not taken any accumulated depreciation. So this amount is going to be 0. My estimated useful life is 4 years. I multiply this result by 2. And what is this going to give me? Well, this is going to give me 90,000, right? Times 2, or $180,000. Now, when I look at this over here, though, that $180,000 is for a full year. I use the asset for September, October, November, and December. So what I'm going to do is I'm going to multiply this result over here by 4/12. When I take 180,000, multiply it by 4/12, I'm going to get $60,000. So now what we need to go through and do is, because we're not including salvage value, we need to go through and figure out if we can continue to depreciate the asset. My acquisition cost is, and this is 2028, we've got 2029, 2030, okay, 2031, and we'll even do 2032. Why not? My acquisition cost is $360,000. No, Gray. We don't chew on the wires. Okay, kitten. Yes, we're going to say hello to a Zoom bombing kitty that I don't want to see get electrocuted. Okay, so we got $360,000. My depreciation expense is, for this first year, is going to be $60,000. Again, 360 the acquisition cost minus the accumulated depreciation, right, which is 0, divided by the estimated useful life, which is 4. Multiply this result by 2. I get 360 divided by 4 is 90, times 2 is going to be over here. 90,000 times 2 is 180. I only used it for 4 months, so I'm going to multiply that result by the time period. Over here, my depreciation expense is 60. That means my accumulated depreciation, or what I've taken to date, is going to be $60,000. Really just 0 plus 60, right? So over here, my accumulated depreciation right was 0, right? And then I just added in over here, I debit depreciation expense and I credit accumulated depreciation. So over here, my ending balance of my accumulated depreciation is going to be 60,000 as of 12/31/28. Okay, so my net book value is going to be my acquisition cost minus my accumulated depreciation. Okay, so over here, this is going to be 300,000. I'm going to compare this amount over here to my salvage value. My salvage value is basically $100,000. Okay, so I'll call this letter D. So if C is greater than D, we are going to continue depreciation. If C is less than D, we're going to have to manually determine depreciation expense. Okay, so over here, because C is greater than D, we continue depreciating. All right. So let's give ourselves some more room. Okay. So now what I'm going to do over here, this is for, I've done depreciation expense for this first year. Let's go to the next year. So over here for 2029, right? What is my formula? Well, my formula has not changed, right? My formula right over here is basically going to be my acquisition cost, which is going to be 360,000 minus 60,000, which is my accumulated depreciation for this basically for this asset. Over here, I've got 4 years. And then I'm going to multiply this result by 2, and this is going to give me my depreciation expense for 2029. Okay, so over here, I've got 300,000 divided by 4, multiply that result by 2. So when I take 300,000 and I divide it by 4, this is going to give me 75,000 times 2 is going to be 150,000. So this is going to be my depreciation expense for 2029. Let's go up here to our chart. Can I take that amount of depreciation expense? Acquisition cost is still 360. My depreciation expense for the year is 150,000. Because I used it for the entire year, it's like I'm multiplying it by 12/12 or 1. My accumulated depreciation, right? Remember, when I'm doing the journal entry, I'm debiting depreciation expense, I'm crediting accumulated depreciation, right? This is a contra asset account, and I use that contra asset account to basically accumulate the depreciation. So in 2028, I took 60,000. And now in 2029, I'm taking 150,000. Okay. So over here, 150,000. So my accumulated depreciation is going to be the total amount of the accumulated depreciation from the prior year, right? This becomes the beginning balance. This is from 2029. So over here, my accumulated depreciation balance is now 210,000. So 12/31/29. Okay. I come over here, right? My accumulated depreciation, prior balance, plus the current year depreciation expense. My net book value is going to be the acquisition cost minus the accumulated depreciation, or over here, right? 360 minus 210 or 150,000. I compare the net book value to the salvage value. I can continue to depreciate the asset because the net book value is greater than the salvage value. If I'm looking at my balance sheet, right? So if I'm looking at my balance sheet as of 9/1/18, when I bought the asset, right? And this again, assets, non-current assets, right? The equipment is a non-current asset. Over here, I'm going to have my equipment. My equipment had an initial value, my acquisition cost of 360. When I went through and purchased the equipment initially, right, I had no accumulated depreciation, right? The first time I went through and did it. This is less AD, is going to be giving me my equipment net or net book value of the equipment. So over here, my accumulated depreciation for this one over here is 0. So my net book value on day 1 is 360. 12/31/18. Equipment doesn't change. My accumulated depreciation over here after the first year was, the last 4 months, was 60. 12/31/19, 360. Over here, my new amount of my accumulated depreciation is 210. So my net book value is 150. Remember, we have to go through and stop once we reach 100,000. Okay, so let's go down over here and take a look at our next one. Okay, so for 2030, we're going to use the same formula, right? So for 2030, my acquisition cost hasn't changed. This is 360,000. But my new accumulated depreciation for 2030 is going to be 210,000. I'm going to divide this result by 4, right? I'm going to multiply that by 2. Okay, so this is going to give me 150,000 divided by 4. I'm going to multiply that result by 2. So this is going to be 150 divided by 4, or 37,500. When I multiply that result by 2, I get 75,000 as tentative depreciation expense for 2030. Now, why do I say it's tentative? Well, we're going to see momentarily if I can take this full amount of depreciation expense. So over here, my acquisition cost is 360. Come over here, basically, and I say, all right, let's do this real quick. Okay. So my depreciation expense is going to be at 75,000. Okay. So my accumulated depreciation, right, tentatively, and let's make this a little bit nicer. Is 75,000. Okay. So actually, I should say this. So my tentative accumulated depreciation is going to be 210, which is my prior plus my current year depreciation, or 285. So 210 plus 75 is 285. My net book value is at 75,000. This is where we have the problem, right? I have to basically, this is over depreciation, right? So I have to manually determine depreciation expense, okay? So for 2030, right, I cannot go through and use what I recorded, right? If I use what I recorded, I'm going to get in trouble because I will have over depreciated the asset, right? So I cannot go through and use these values here, right? I cannot do this because my net book value falls below my salvage value. So what I need to go through and do is to manually calculate it. So how do I figure this out? Well, what you're going to do is you're going to go to the prior year net book value of 150,000 minus the salvage value of 100. This is going to give you the manual depreciation expense of 50. Okay. So if I take 50,000 of depreciation expense, that means my accumulated depreciation is now at 260,000. My net book value is at 100,000, which equals my salvage value. So right over here, I can't use this 75. I have to use 50,000. So over here, when I go through and add this up, this is how I'm getting over here to 260,000. Okay, so come in right over here. I get to, boy, oh boy, Bennett, 9/1/28. So what happens when you go into the future? 12/31/28, 12/31/30, 12/31/31. So in 30/31, did I do it right down over here? God, Bennett, this is terrible. Hold on. I even just screwed this one up here too. Hold on. Oh, 12/31/29, 12/31/30. Wow, I'm losing it. Okay. So my accumulated depreciation is going to be 260. So my net book value is 100,000. For 2030, the amount of depreciation expense that I'm going to go through and take is going to be how much? Well, I'm going to go ahead and take over here. The amount I took was 50,000. And over here, you're getting over here to 50,000. Okay. And if you're wondering, this is debit, credit, credit, debit, credit. I sound like a frog. Okay, so right over here, which my cat would probably jump after right now. Okay, so right over here, this is how I go through and record the depreciation expense. Remember, for this last year or for this 2030 year, I cannot take the 75,000, right? I can't use this number. If I use the number, I would over depreciate the asset. So now over here for 2031, what do? We're not going to take any depreciation expense. Why is that? Because the asset has been fully depreciated. We have to stop using it. We can still use the asset, but we can just no longer go through and appreciate it, to continue to depreciate the asset. And it's basically because I can't go below salvage value. So this is a great exercise in terms of, how do you really make sure that you go through and know it? This is really a good way to go through and do it. So the depreciation expense for the years ended December 31st, 2028, 2029, 2030. We've done this over here in our chart, right? I've also done the journal entry, right? I tend to not ask this a lot on my exams because once you've kind of already done this once or twice, the journal entry is exactly the same. So over here, done depreciation expense, balance sheet section, right? What does that look like? Well, that was what we were going through and doing down here, right? This would be the name of the company, balance sheet, non-current asset, right? It's not a current asset, it's non-current. And then again, over here, 12/31/31, because I stopped taking depreciation expense, it just keeps on going on and on. Okay, so then over here, the journal entries, which we've already gone through and have done. So this is double declining balance. This is generally looked at as one of the harder methods to go through and to master. But if you kind of go through and take the time, shouldn't be so bad. In any event, I want to thank you. Appreciate you leaving any kind of questions you guys might have below. And I also appreciate you liking and subscribing to the channel. Have a great rest of your day, and I look forward to seeing you on future videos. Thank you so much.